Have you ever wondered what separates successful investors from those who struggle during market turbulence? How can we learn from history's most prominent financial disasters and tackle the emotional roller coaster of trading? Well, you're in the right place because today we're diving into these critical topics. In this video, we will dissect three infamous market crashes, starting with the granddaddy of them all, the 1929 Great Depression. We'll explore the causes, consequences, and invaluable lessons. Then, we'll fast forward to the dot-com bubble burst in 2000, unraveling its contributing factors and lessons learned. Finally, we'll scrutinize the 2008 financial crisis and the crucial takeaways for the modern investor. So, are you ready to gain insights that could transform your approach to trading and investing? Let's start by journeying back to 1929, which reshaped financial markets forever. Before we explore the crash itself, let's set the stage. In the late 1920s, the United States was experiencing a period of unprecedented prosperity known as the Roaring Twenties. The stock market was booming and optimism was high. Then came the Black Tuesday, October 29, 1929. This was the day when the stock market crashed, wiping out billions of dollars in wealth. What led to this crash? Several factors played a role, including rampant speculation, margin trading, and overvaluation of stocks. The consequences were devastating. Businesses collapsed, banks failed, and millions of Americans lost their jobs. Unemployment soared to unprecedented levels. The Great Depression wasn't just a catastrophic event, it also provided invaluable lessons for the world of finance. Let's explore some of these lessons. Back in 1929, many investors had all their eggs in one basket. They were heavily concentrated in the stock market, believing it was a surefire way to wealth. But when the market crashed, they suffered devastating losses. The consequences were profound. Those who weren't diversified faced financial ruin, losing their savings and, in some cases, even their homes. Putting all your investments in one asset class was a harsh lesson in the perils. Diversification, on the other hand, spreads your investments across different asset classes. By doing so, you can mitigate risk. When one asset class underperforms or experiences a downturn, the impact on your overall portfolio is less severe because other assets can cushion the blow. So, the lesson here is clear. Don't put all your eggs in one basket. Diversify your investments across stocks, bonds, real estate, and other asset classes. It's an essential strategy for reducing risk and increasing the resilience of your portfolio. Now, let's fast forward to the turn of the millennium, to the dot-com bubble burst of 2000. This was a period of wild speculation and optimism surrounding internet-related stocks, which eventually came crashing down. The dot-com bubble was characterized by an exuberant belief that the internet would revolutionize the world, leading to irrational investments in dot-com companies, many of which had little or no earnings. So what contributed to this bubble? First, there was an unprecedented wave of speculative investments driven by fear of missing out or FOMO. People believed that these tech companies would only go up, but when the bubble burst in 2000, it led to massive losses. Many dot-com companies went bankrupt and stock prices plummeted, wiping billions of dollars in market value. What lessons can we learn from the dot-com bubble burst? Lesson 1 is understanding the risk associated with speculative bubbles. It's a warning sign when the market is driven more by hype than fundamentals. Lesson 2 is the importance of fundamental analysis. Investing based on solid financials and a transparent business model rather than hype can help you avoid the pitfalls of speculative bubbles. Lastly, Lesson 3. The market's resilience to technological changes. While many dot-com companies failed, the technology sector eventually rebounded and evolved, demonstrating the market's ability to adapt. Lastly, let's turn our attention to one of the most significant financial crises in recent history, the 2008 financial crisis. This event shook global markets, and its reverberations are still felt today. In 2008, the world faced a severe financial meltdown. It was a culmination of factors, including a housing market bubble, risky financial products, and a lack of oversight. The crisis exposed systematic risks and failures in the financial industry. Large institutions like Lehman Brothers collapsed, and the interconnectedness of global markets became painfully evident. What are the lessons learned from the 2008 financial crisis? Well, lesson 1 is the need for strong financial regulation. Inadequate oversight allowed risky practices to flourish, leading to the crisis. Today, regulatory reforms aim to prevent a repeat of those mistakes. Lesson 2 is understanding the risks associated with complex financial products. Many investors and institutions needed to grasp the complexities of products like mortgage-backed securities fully. It's a reminder to understand what you're investing in thoroughly. Lesson 3 underscores the importance of due diligence when investing in financial institutions. During the crisis, some investors need to realize the extent of exposure they had to struggling banks. It's crucial to understand where your money is and what risks you're taking. So, the 2008 financial crisis reminds us of the critical need for robust regulation, understanding complex investments, and conducting thorough due diligence. These lessons are as relevant as ever for today's investors. And that's a wrap for today's video. We hope you found this content informative and valuable for your trading and investing journey. Thank you for tuning in today. Check out more videos about fundamental analysis and technical analysis. Take your financial future into your own hands, investing for beginners. These videos will help you dive into the world of analysis, an essential approach for making informed investment decisions. Until next time,